Welcome back to Make a Meal, the channel where we all want to make it seven figures. So let's get started on that journey right now. Today, I'd like to talk to you about WBD, Warner Brothers Discovery stock, and the trade we made in the last video. If this makes no sense to you right here, we did this last time. I'll throw a card up here and click on that and check it out. So I won't explain this whole thing over again. This whole thing, suffice it to say, was just so that we could read this one line. That we sold to open 50 contracts of Warner Brothers expiring December 20 at a strike of $6 per share and their puts, and we received a premium. If we understand what all that means, then we also understand that this contract, if it was held to expiration, would return about 2.5% on your money, or annualized about 8.5%. If that didn't make any sense, go watch that video right now. Otherwise, let's proceed. So I would just like to do a quick update of where we are. Now, don't lose your pants, okay? Because I'm not losing mine, that I'm down $600. And I'll show you in a minute in the broker. The stock price has sunk from $8 a share to $7 a share. And that is no bueno for moi, right? Minus 10% in the stock price. As you would expect, the price to buy the option back, and I'll show that in the simulation in a sec above, increased. So I have a loss. On paper, that's the critical part. On paper, I don't have to realize this loss. I can hold it as long as I want. Even if I'm losing at the expiration date, I still don't have to pay that price. So I almost never look at this price sometimes, partly because it would get me down and I would never do this kind of thing. And the other part of it is it's not very helpful to the strategy, because the strategy is to sit and wait and be patient. That probability that I showed you that one time in the video, I'll throw it up here if you're wondering about that. Those probabilities, you have to hold it all the way to the expiration date to get those probabilities. If you close a little early, the probabilities are different, okay? So don't panic that it's down. We started the contract with a 1 in 5 chance of losing. So this is the probability in the money, is the probability that the contract would execute and that I will have to buy those shares. That's me losing. There's an 8 in 10 chance that the contract will expire worthless, just like your home or auto insurance expires at every term. And I'll just save that premium and I won't have to pay back anything and I'll profit. The probability has increased up to a 3 in 10 chance that I'll lose. So I only have a 70% chance of winning. So that's part of the reason that this unrealized losses here on paper. The probability of touch is about double the probability in the money, and that's just a probability that the price would go from $7 today to below $6. So I just wanted to show you what this means. So it's about $28 per contract to buy it back. Today is September 8th, so let's see what the AROI is. So we're not paying 28, we're actually paying 28 times 50. I wish it was 100%, but I'm down negative 50%. So what this means, if I was to close this after a week and a half and I was to keep doing that, if I was to do this 30 or 40 times in a year and lose the same amount every time, I'd be down 50% on my money. So if I panicked right now and I said, oh my gosh, Warner Brothers, I'm down 600. Oh no, I better just pay it and buy it back. I'll pay the 1,400. I don't want to be in this contract, stuck in this liability anymore. Or if I had a different analysis, if I had a more thoughtful approach and I said, hey, Warner Brothers, something changed. I made a mistake. Oh no, those numbers don't match up. Oh, they changed the CEO. Oh, this news came out. Oh boy, my thesis on the company changed. I might want to close early for a loss and just cut those losses because I think there's going to be bigger losses later. But don't panic. Like, if you're doing that on every contract, you're doing something wrong. You should never be writing these contracts on companies you don't believe in and want to hold long term. That's the rub. That's the key of this strategy. That keeps my risk low, that I would be happy owning this company at this price. That's the fundamental analysis. And I've talked about that in previous videos too. I find that sometimes you have losses in these contracts, but the majority, they are big gainers. And the only question is by how much. So it's not that useful to look at these scenarios, but it's fun to see, and it's good to be aware of that type of thinking. Price to strike ratio, this is kind of my own little metric that I also like to track. I think it's very useful of thinking of options of how far the price of the stock is away from the strike price at which you'll have to buy it. So let's check those visuals out right now. Visualizing price to strike ratio. I've defined it here as the distance from stock price to strike price as scaled by stock price. So what that formula means is you just take the price on the day it's trading subtract the strike, and then take that number and divide it by this original price. So as you can see, as the price of the stock goes down, as stock price decreases, the PS ratio also goes down. And we just want to know what's that ratio? How far is the stock price away from that strike price, that red line? Because we don't want to write our options too close, because then it can get on the other side of it and we can lose a lot of money. So I like to write them at least 10-15% away. So that's one KPI that you can use while trading options to also mitigate and assess some of the risks associated. And if you notice that we got about a third closer to the strike, this is how I'm thinking in my head like that. I'm not doing all this math in my head. I'm thinking visually in my head like this. I'm thinking, how close am I to this strike? Because there's this big red line here, you noticed, that is the no bueno line, and I don't like to be on this side of it. We like to be on this side of the line so that we can collect all the premium in the world and none of the shares. I've just included some break-even calcs also. The strike price isn't quite the break-even point. You have to subtract the premium per share. Instead of paying $6 per share, I'm paying about $5.85. What's cool about that is if you look on the day that I wrote the contract was $8.05. If I had just bought the shares that day, which my research told me $8 is a fine price for this company. So I'm just trying to get some gravy, go below and buy it at $6. If I'd bought it at $8, I'd be down that almost $1 per share, right? But I'm not. So that's one good thing about writing these options contracts. They kind of mitigate some of the risks of share ownership. The downside, as I mentioned in a previous video, is that you don't collect the dividend along the way. Okay, so if you're holding these contracts, you don't collect dividends because you're not actually owning the shares. But not actually owning the shares also de-risks you a little bit. I'm not scared. Like I would have been scared 10 years ago if I'd put in 30 G's and been down this much, but I'm not afraid. So next, I'm just going to show you in the portfolio, just to show you that I'm actually down $600 odd. You can see we have WBD strike of 6 closing December 20. We have 50 contracts, and they've chosen the price of 28 just because it's kind of in the middle of this bid-ask spread. So 28 times 50 gives you that negative 1,400, and then you add back the $773, you get that 626.51, just like you saw in my Excel spreadsheet. So you don't want to panic when you see these. When you write contracts, the overwhelming likelihood is that you're going to be in the red like this in the beginning, and the trick is to not panic, is to just hold those to expiration and just hold on. Just don't check it every day and you'll make more money. So if you like this kind of content, subscribe to the channel. It really helps support it.